Volatility has returned. So let's bring in our guest for the next 30 minutes. With us now, Mouhammed Choukeir, Chief Investment Officer at Kleinwort Hambros. That's a big move.
Yeah.
How did it affect the way you do business? How will it affect the way you do business? Because it affects liquidity, it affects a whole bunch of things, and the lag effect is quite significant.
Yeah, I mean, it's a big move and it's long overdue. In fact, the move is not the surprise, it's the period before that that's the surprise. As we know, we've been experiencing a very long period of low volatility. I mean, just to give you some context, in the last month alone, we've seen 8 days of 1% or more move in equity markets. Yet in the whole of 2017, we only experienced 7.
Yep.
So that just goes to show how big it is. But actually, an average year experiences 40 of those days. So we should expect more of this higher volatility, and that's more of the norm rather than the low volatility period.
How does it affect the way you do business? How does it affect the liquidity in the portfolios? How does it affect the models that you use to model risk?
Well, it doesn't really affect liquidity yet, right? Clearly, if it does get to a stress scenario and we see spreads widen and there's no bid on some of the assets, which we haven't seen, then it starts to impact liquidity. The jump that we've seen in the VIX so far is, dare I say it, normal. What we have previous to that is the abnormality. So actually, this hasn't affected it in a huge way.
Do you see volatility across all asset classes, Mohammed? I mean, I thought it was interesting that David Einhorn's fund had such a big drop in January and February. He's betting big against these bubble stocks, which have been almost a sure thing bet for the last year. Do you see all assets correlated as far as a jump in volatility?
Yeah, I mean, within equity markets, there's definitely been a correlation. On the way down in February, everything went down. There was no safe haven within the equity market. The jump in volatility took place, as you know, within equities, but also within bonds, because that was the trigger, if you like, what happened in the back of the US expectations of a rise in rates. So, in essence, the volatility spiked both in equities and in bonds. There was no safe place to hide.
Volatility was one of those big kind of bubble trades, or the lack thereof, that just kept on going like the Energizer bunny. What do you think about that kind of basket of assets that just sort of defied expectations, although everybody was on the same trade there? Do you think that all of those one-way bets are going to turn around?
Well, in essence, trading volatility is a leverage trade. I mean, the volatility of volatility is very high, as you know, and we just, in the chart that we were looking at earlier, so investing in it to generate returns, whether it's short or long term, it requires a lot of risk taking. In fact, the more prudent way to think of volatility is to actually look at it in the context of a portfolio where it allows you to mitigate some of the risks that you have in the portfolio rather than trade it outright for investment reasons. So it's more for hedging and more for diversifying your portfolio.
So what do I do now? Do I come into the new month? Do I buy stocks? Do I basically discount February and just say it's a return to normal? There's nothing to worry about here. The fundamentals underpinning the market, i.e. earnings, etc., still exist, and as a result of which I just carry on. Yeah.
Well, actually, let's look at the facts, right? The economy is strong.
Yep.
There's no dispute around that, and actually it keeps punching on all cylinders globally. Yep. It's a uniform recovery. Earnings are robust. We're seeing companies continue to deliver good returns, and that environment is strong for risk assets. The challenge, which existed before February and continues today, is the excessive valuation. Yep. So for us right now, we continue to be in equities for the reasons that I talked about, which is earnings and the economy, but we're cautious because of valuation, so we're dialing down risk. This is not an environment to be aggressive into cash or short-term bonds. I know they're not yielding very much, but actually in an environment like this, they retain their nominal value.
So how much has that portion of your portfolio changed?
So again, depending on the risk profile that we would have in the strategy, it could be anywhere between 3 and, say, 10%.